Thank you very much, President Sakurai, and thank you to the Japan Society for organizing today's fascinating event titled Abenomics, Could This Time Be Different? The topic could hardly be more timely. Japan's new efforts to end a generation of deflation and boost long-term economic growth will be important not only for her citizens, but for the global economy as well. The results of ongoing policy experiments will guide other countries that have exhausted conventional monetary policy tools and face ballooning public debt. The success or failure of Japan's policies also will influence future textbooks on macroeconomics around the world. Today's program will last approximately 1 hour. We'll begin with a 10-minute presentation by each panelist, followed by a short discussion that I will moderate. The final half hour of the program will be devoted to questions from the audience. Let me now briefly introduce our two distinguished panelists. Paul Sheard is the Chief Global Economist and Head of Global Economics and Research for Standard & Poor's Rating Services, and is a member of the S&P Executive Committee. Previously, he held similar research positions at Nomura Securities and at Lehman Brothers. Nathan Sheets is the Global Head of International Economics at Citigroup. Previously, he was the Director of the Federal Reserve Board's Division of International Finance and one of 3 economists to the Federal Open Market Committee. Altogether, he spent 18 years at the Fed. Now, following alphabetical order, let me ask Paul to begin the presentations.
Thanks very much, Kim. Well, that had to go to the second letter to get up here first, but that was lucky of me. So again, a great pleasure to be back here at the Japan Society and to have the opportunity to share our thoughts on Japan. So let's dive straight in here. Just to remind you, there are 3 elements of so-called Abenomics. One is the idea that the Bank of Japan should be held accountable for achieving a 2% CPI inflation rate over the next 2 years. The second is a turn in fiscal policy, really from more of a contractionary stance to what is called flexible fiscal policy, which basically means over the next 2 to 3 years being prepared to support the recovery with more fiscal expansion. And then the third element, the so-called third arrow, is the growth-enhancing structural reform. And the idea of this policy mix is to really do 2 things. One is to lift Japan out of deflation and also to lift real growth at the same time. I guess what I would, one question immediately comes up and we may discuss is why did it take Japan so long to get around to this particular policy mix? Because although it's called Abenomics, as if it's something special, it's really quite a conventional policy mix for an economy that is in deflation and you're trying to get it out of deflation. Expansionary monetary policy, expansionary fiscal policy, and then a little bit of structural reform never goes astray either. If you compare this, for example, those of you who remember the Koizumi administration, and there are some quite interesting parallels between the Koizumi and the Abe administrations. That was the last really exciting administration, if you like. Mr. Koizumi and Mr. Takenaka were also very focused on ending deflation. But the policy mix then was essentially to delegate the monetary policy to the Bank of Japan. Mr. Koizumi never really interfered or took too much overt interest in monetary policy, but on the fiscal side was actually to engage in quite a trenchant fiscal consolidation. As a macro policy mix trying to move an economy out of deflation, I have to say I always had problems with that. So full marks to Mr. Abe for coming up with this conventional monetary policy mix. But the really revolutionary part, and the one that I would like to focus on more, and I think we'll probably focus on quite a bit, is the monetary policy part. Because under Governor Shirakawa, who was the governor until, I guess, 20th of March this year, there was a very different narrative. And there was very different policy action around using monetary policy to end deflation. And again, just recall here what the problem is. Japan has been in a deflation for 15 to 18 years, depending on how you measure it. The CPI in the last 10 years has averaged minus 0.1. That's not very negative, but central banks usually target around about 2% CPI inflation. the GDP deflator, a broader measure of the overall price level, if you like, associated with the goods and services produced in the economy, has been falling in Japan and is still falling for 18 years, and it's down about 18% in that period. How unusual is that? Well, if you compared that with the US, for example, in the same period, the GDP deflator here is up 46%. So there's more than a 60% diversion over that period between the deflators in the two countries that we're looking at here. So that backdrop suggests, well, yes, it's quite sensible for a central bank to be very aggressive trying to end deflation. After all, that is the central bank's job. But what was very unusual and at times frustrating to Bank of Japan watchers like myself was that the narrative at the Bank of Japan, particularly under Governor Shirakawa, was very, very different. It basically said, look, deflation in Japan is a real economy, not a monetary a real economy, not a monetary phenomenon. Therefore, and what did that mean? Well, basically, the argument from Governor Shirakawa was the cause of deflation was not insufficiently aggressive monetary policy, but rather was the demographics and the falling potential growth rate. Real growth was falling, and that meant you had deflation. That was the theory. Now, among economists, I think that's a rather controversial idea. Some economists might agree, but I think the bulk of the profession would say, hold on a minute, inflation surely at some level is a monetary phenomenon. Surely the central bank can control inflation. That's certainly what Mr. Bernanke and other central bankers believe. But that theory was really expressly rejected by the Bank of Japan under Governor Shirakawa. Now that's a little bit problematic because the modern theory, as I understand it, of monetary policy places a lot of weight on inflation expectations management. One of the reasons the central bank can achieve, let's say a 2% inflation target, is that it is able to steer the public's expectations of future inflation in that direction. And if it can do that, that helps for that inflation outcome to be a self-fulfilling prophecy. The problem is, if you start from the reverse premise that the central bank is broadcasting the message that it does not believe it has the tools or the ability to end deflation, then it's quite natural for the public to continue to expect deflation. That means that deflation continues as a self-fulfilling prophecy. But even worse still, the longer deflation goes on, the more the central bank itself, in this case the Bank of Japan, is convinced that it's right. It can say, look, deflation continues. We told you that monetary policy can't end deflation. So this is really where it gets very interesting because clearly the first arrow in the quiver of Mr. Abe was to say, I reject that theory. And Mr. Abe looked around for a governor to replace Governor Shirakawa because the 5-year term was up in March, who essentially rejected that Bank of Japan orthodoxy. And Mr. Kuroda is exactly that man. What's very important here, I think, is Mr. Kuroda has broadcast a message which is very different, which is to say, yes, we can. That's a familiar phrase from the US, of course. I'm the central bank governor. My job is to control inflation. I'm not going to shirk that responsibility. It will take me 2 years because monetary policy acts with variable and long lags, as the expression goes. But over a 2-year horizon, we should be able to do this. A very, very different message, a revolutionary message compared to the message under the previous governor. But then, of course, economists have a term, cheap talk. Cheap talk doesn't work. It was very important that Governor Kuroda back up that message with very strong action. Action that lent or invested the message with some level of credibility. And of course, we saw the results of that on 4th of April. And hats off to Mr. Kuroda and the policy board of the Bank of Japan and the staff of the Bank of Japan here for doing that because they really managed to pull off the impossible. Expectations were very high, and yet Mr. Kuroda exceeded expectations, announcing a change in the operating procedure of the Bank of Japan to now target the monetary base, announcing that the monetary base would be doubled between now and the end of 2014, announcing that they would buy a heck of a lot of JGBs. Not just that, that they would lengthen the maturity of the JGBs from slightly below 3 years on average to around about 7 years. In quantitative easing theory, that should give more easing effect. They also doubled admittedly from a very low base, the amount of risk assets that the Bank of Japan was purchasing, and also something that surprised, I think, pretty much everybody, abolished the asset purchase program, which was the cornerstone of the monetary policy framework previously, but had become very convoluted. So Mr. Kuroda here has really simplified things, made it very, very easy to understand. And again, if you believe the expectations management theory, that's very, very important, because the man or woman in the street, the taxi driver, needs to be able to understand exactly what the Bank of Japan is doing, something very aggressive. So a real 180-degree turn and a big surprise, and something certainly that I would not have forecast. Now, the $64,000 question, or 290 trillion yen question, is, will it work? And here, I have to say, I'm very hopeful, but also rather skeptical. I'm not ready to bang the table here and say, yes, this is definitely going to work. So what's holding me back? One thing is, just to bear in mind here, is that what the Bank of Japan looks very aggressive. But I would argue that to a large extent, and it is aggressive, but it's also the Bank of Japan playing catch-up to a certain extent in terms of the expansion of the balance sheet. Even after the Bank of Japan does all this doubling of the monetary base, the expansion of the balance sheet relative to, say, the beginning of the financial crisis, August 2008, will be about 166% expansion of the balance sheet. Well, the Fed is already, admittedly from a smaller base, at 250% expansion. The Bank of England at 333% expansion. So yes, it looks aggressive, it is aggressive, but bear in mind that the Bank of Japan here is really playing catch-up to a certain extent. Second reason for having a fairly high bar to judge these things is that whereas the Fed and Mr. Bernanke have been operating monetary policy to keep inflation expectations well anchored and to continue to be able to achieve the target, the Bank of Japan is trying to move from 15 years of entrenched deflation to dislodge inflationary expectations and recalibrate, re-anchor them at a higher level, roughly about 2% higher. That's a much bigger ask to do. Now, the markets are on the Bank of Japan's side. There has to be a transmission mechanism of monetary policy for it to work. What is that transmission mechanism? Well, we've seen a couple of aspects. One is obviously the yen. The yen has moved 25 big figures, as traders say, from about 75 yen against the dollar to close to 100. Now, bear in mind, of course, that the yen had strengthened since the financial crisis and since the 3/11 tragedy fairly dramatically to reach all-time nominal highs. So there's a fair amount of retracement here where the yen is moving back to something which is a little bit more reasonable in terms of level. That should give a boost to the export sector and feed through to the domestic economy, so that's positive. The other key transmission channel is the equity market, obviously. And it's very interesting to look at the data here, at least I find it interesting. Foreigners turned to be net buyers of Japanese equities the very week that Mr. Noda announced that there would be an election, because investors had obviously, caught a little bit of a glimpse of what Mr. Abe was on about. They said, aha, he'll probably win the election, and people started to put money into Japan. In the 22 weeks since foreign investors turned net buyers of Japanese equities, they have bought equities for 21 out of 22 weeks. There was just 1 week they were net sellers, small net sellers. And they've accumulated more than 8 trillion yen of equities in that period. And the equity market is up around about 57%. In a period in which the S&P is up only about 13%. So there's been a massive influx. For that period, a record amount of foreign investor buying into the Japanese market, and the Japanese market has moved up dramatically. That should engender positive wealth effects, more confidence. It's really a tailwind for Mr. Kuroda. So why aren't I popping the champagne bottles up here? Well, there's a hint in what I just said. It's foreign investors that are driving the yen carry trade, and it's foreign investors that are driving the equity market. And if those foreign investors are investing on the basis that Japan is changing, which is going to require a change in the behavior and mindset of the Japanese people, well, if that's going to be the case, at some point, Japanese investors, domestic investors, the Japanese people, presumably need to jump on board this train as well. So for as long as the market moves are being driven just by foreigners, I think it's inherently a somewhat vulnerable situation. Because if foreigners at some point say, you know what, perhaps Japan's not changing, perhaps there's a little bit of disappointment with policy follow-through here, but we've made very, very good profits, and they start to exit the equity market in particular, you could actually get a renewal of a sort of deflationary pressure. So no room for complacency. I have a few more thoughts I'd like to share with you, but probably I'll leave that to the discussion period. Put me in the hopeful but still somewhat skeptical camp. Thank you very much.
Well, I am very happy indeed to be here, and broadly agreed with what Paul had to say in his characterization of Abenomics. And what I'll try to do is just add some complementary thoughts and flesh out a couple of the arguments that Paul made. So I view Kuroda's announcement a few weeks ago as one of truly historic proportions. And the analogy that I would draw is that this was Japan's Volcker moment. So that in the fall of 1979, Paul Volcker took his big fist and slammed it on the table and said, we in the United States will defeat inflation. In the terminology of our times, he said, we will do whatever it takes. And consistent with that, he changed the target for monetary policy and pursued a very vigorous attack on inflation and inflation expectations. And I see Governor Kuroda doing something broadly similar a few weeks ago. He slammed his fist on the table and he said, Japan will defeat deflation. We will do whatever it takes. And consistent with that, there were a number of commitments that he made. But to me, the most striking one was he promised to double the monetary base in 2 years. And when I look through his central banking history, I think that's an unprecedented commitment. Now, we do know that there are central banks in the past who have doubled the monetary base in 2 years, not always with happy outcomes. But I don't know of any central bank that has said, our goal is to defeat deflation and we're going to be this aggressive to achieve it. This then raises the question that Paul talked about in some detail, and that is this really going to work? Is this going to be an effective program? Will it actually achieve its goal of ending deflation? Well, jury's still out. And like Paul, I'm mixed in my views on it. I think it remains to be seen. But what we can say is that so far, the BOJ and Prime Minister Abe have seen a very vigorous response in the financial markets. And I speak to investors every day. And I would say, by and large, the investment community says yes, Japan will be successful in its goal. What have we seen so far? We've seen a marked weakening of the yen on the order of 20 to 25% depreciation since early October. Substantially higher equity markets, as Paul mentioned. Japanese equities are up 50 to 60% over the last 6 months. And we notably have also seen some very significant volatility in JGB yields. And I think the JGB market is, in some sense, a battleground here for the implementation of Abenomics. And thinking about investors in those markets, they have very mixed incentives. On the one hand, the BOJ is explicitly trying to stoke inflation. And when you tell me inflation is going to be higher, that should mean I have higher long-term real interest rates. But at the same time, the BOJ is going to achieve that objective through the modality of significant purchases in long-term government and other government bonds. And I see this as being a bit of a tug of war as to which of these effects dominates. And quite frankly, it doesn't surprise me. My guess would have been that we'd see a lot of volatility without a whole lot of trend in JGBs. But so far, financial markets have responded very favorably to this. Now, in looking ahead, where will the effect of Abenomics come from? Given the low rate environment and evidence suggesting that equity wealth effects in Japan are relatively limited, My feeling is that the lion's share of the economic effects of Abenomics are going to be felt through depreciation of the exchange rate. And by this, I'm thinking in particular of the BOJ's policies, because I very much recognize that there are two other arrows. One is the fiscal, which I'm not terribly optimistic is going to be enormously powerful. But the other is the structural, which I think in certain respects, Governor Shirakawa was absolutely right. I think monetary policy can fight deflation, but if we want to meaningfully raise Japan's potential growth and raise trend growth in Japan over the medium to long run, deep structural reforms are going to be necessary. So that arrow is of great importance. But here I'm focusing on the impact of the BOJ's policies. So with that in mind, well, what are the effects of yen depreciation on the Japanese economy? I've actually done a fair amount of work on this topic over the last couple of months in particular, but over a number of years. So when I look at the economic effects of yen depreciation, the most important channel on the economy in my mind comes through increased competitiveness. So here I take a hallmark of a 30% decline in the yen, and this is assuming that the yen declines not only against the dollar, but against all currencies. So this is a little bit more than what we've seen so far, but is a reasonable guess as this program proceeds as to where the yen might end up. So my work suggests that a 30% yen depreciation is likely to imply something like a 2% rise in real GDP for Japan, and that this will occur over a period of roughly 3 years. So my guess is that yen depreciation associated with Abenomics is likely to raise Japanese growth by roughly 0.5 to 0.75 of a percentage point over the next few years. So I think this is a significant support to growth. Another way to put this is I think Abenomics goes some way to helping close the output gap. What it doesn't do through this channel is permanently raise potential or trend growth in Japan. This would be something that would be lasting for several years. So that's good news. Now, bad news is that there's also an adverse terms of trade shock here, that with the sharp depreciation of the exchange rate, externally oriented corporates have scope to raise their export prices. But what's also true, and it's clearly embedded in the data, is that importers in Japan are also going to raise their yen-denominated prices. And what we know is that the import prices of commodities in particular are very, very sensitive to the exchange rate. That's true in the United States, it's true in Japan, it's true globally. So what you're going to see is this is a good price shock for some of the major corporates that are externally oriented, but this is a bad price shock for importers and particularly for households as they start looking at their energy and their fuel bills. Now you can argue back, well, what are you trying to do? You're trying to create expectations of inflation in Japan. How are you going to do that? Maybe one of the ways you're going to do that is through higher commodity prices. So maybe you can make an argument that this adverse terms of trade effect associated with the depreciation of the yen is actually helpful in raising inflation and inflation expectations, which then cuts to the next point. And that is that as the exchange rate falls, there's a fair amount of evidence that inflation rises. Headline inflation rises a fair amount more than core inflation. And here I mean Western core, which excludes commodities, food, and energy. So the 30% depreciation would be associated with something like a 1 to 1.25% rise in the rate of inflation. But that would persist for only a year or two. And then it would fall back to where it was. So this is not a permanent shift in the determination or the performance of inflation in Japan. So this really takes me to my bottom line here, is that these effects that I've described on this chart seem broadly helpful, some faster growth, some higher inflation. They go ways toward attacking some of the sclerosis that's afflicted the Japanese economy. But they don't seem a permanent solution to deflation. That indeed what it's going to take is an increase in inflation expectations. That people in Japan are going to have to come to believe that inflation is going to be higher. Now, how is that going to happen? Frankly, this is something that economists know very, very little about. Central banks know very, very little about what determines inflation expectations. What does it take when you have inflation expectations for years and years at 1%? What does it take to get them up to 2%? This is really a question more for psychologists and sociologists. Now, that said, my story is what Kuroda is trying to do, is that Kuroda is trying to put a policy on the table that the Japanese public looks at and says, Governor Kuroda is crazy. He's unhinged. He is bound and determined to do absolutely whatever it takes to defeat deflation. And when they look, they say, wow, if he's this committed and he's doubling the base and he says he'll do more if necessary, we are going to have inflation in Japan. So you have to do something big and bold and dramatic, like Paul Volcker did, and I think like Kuroda does. So I think there's a chance that a year or two forward, we're going to see this blue line up toward 2%. Now let me just conclude. I had one more slide, but I'm going to skip it. Let me just conclude with the thought that there are risks around this program. If the program fails, it could be risky. The credibility of the Bank of Japan could be jeopardized and sacrificed. Similarly, if the program succeeds, there could be risk. Now, let's suppose that inflation expectations rise to 2%, like the Bank of Japan has targeted. Where did JGB yields go? 3, maybe 3.5. What implications does that have for the balance sheet of Japanese banks that are holding JGBs? What about government debt? What about the financing of this debt with 250% of GDP of debt? If JGB yields are at 1%, that's a manageable burden. If yields are up to 3 or 3.5%, that becomes a very, very heavy fiscal burden on the Japanese economy. So there are lots of risks out there, but I do agree with Paul's assessment that it was a time finally to do something. And I think at this point, action is better than inaction. And if there are challenges associated with success, I guess we'll have to, and the Japanese authorities will have to deal with those as they arise. Thank you very much.
I enjoyed the way Nathan ended that discussion. The argument is that there's a huge downside if they succeed, and there's a huge downside if they fail, and you get to pick your medicine. Starting at that point, this is one episode where the need for coordinating monetary and fiscal policy may be greater than in almost any other circumstance I can think of. When's the right time to start fiscal consolidation when you're trying to raise inflation expectations? Who wants to jump in?
Let me give Nathan a chance to draw his breath there. I've had a little rest,
Okay.
and come to that point. And again, I hasten to say I'm speaking as Paul Sheard, the economist here, not as any official view of Standard and Poor's on the Japan sovereign rating. Let me get that out of the way. But what I've argued for many years, Kim, on that issue is again just a very simple fact that if you have an economy in deflation, it's either there because of the output gap or it's there because these inflation expectations have become deflationary and become embedded. And you do really need to pull your macro levers very hard, very aggressively, to get the economy out of deflation. And that argues for a coordinated, aggressive monetary and fiscal expansion. Now, what the Japanese have done over the years is sort of put their foot on the monetary accelerator, but then put their foot on the fiscal brake. And I think that has proved to be kind of productive. And I would be worried this time as well. I think that this really is a wonderful moment of opportunity for Japan, but the stakes are very, very high, because if Japanese policymakers fub this one, if they don't execute, having raised expectations so high, I think it's going to be very, very difficult to repeat this act. It took about 10 years to get from Koizumi excitement to Abe excitement. I think it would be a pretty lost cause. So I would, if I was advising Japanese policymakers here, say really make sure you nail this one. And I think that would argue for really sticking to the second arrow of the Abenomics, which is the flexible fiscal policy, and it's stated in the policy for 2 to 3 years. Now, what worries me here is that there's an alternative kind of narrative going on in Japan, which is, and it sounds a little bit cynical maybe, that perhaps what is driving things here is not just purely and simply the desire to get out of deflation, but rather the desire to make sure that the conditions for the government to push ahead with the hike in the consumption tax, 5 to 8% April next year, and then 10% in October 2015, that the conditions for doing that, which are written into the legislation last August, are actually met. And if that's what's going on here, that Japan is heading for another situation where it has a monetary stimulus with a fiscal contraction, I think that might be risking the deflation, the attempt to end deflation.
You want to jump in, Nathan?
I would say that the only thing worse than delaying fiscal consolidation is actually doing it. So I think that the Japanese authorities, in some sense, their options are constrained. And I think that they have to delay it for some time until they're confident that they have a much stronger expansion than what we've seen to date. A related point is that defeating deflation is actually going to be very conducive to improving Japanese debt dynamics. So one of the things you're going to have as inflation starts to rise is that you're going to have faster nominal GDP growth. And that's going to start helping that denominator. One of the reasons why Japan's debt to GDP ratio is so high is the nominal GDP is actually lower than it was 20, 25 years ago. And you start getting it to grow and expand, that's going to help naturally bring down the debt to GDP ratio. It's not sufficient, but it will, instead of being a contractionary force, a adverse force, a headwind on fiscal, it's going to start being a positive if they can succeed.
Okay. Let's. We don't have a lot of time, so let me open it up to the floor right away. I'll interject with other questions, but there may be people out there having listened who'd like to jump in. One favor, if please announce your name and your affiliation before you begin to pose your question. Go right ahead.
George Feldman with AECOM. In the United States, this stimulus almost always involves stimulating demand, encouraging people to buy cars, houses, things. That discussion is totally lacking in every discussion that I've ever heard of the Japanese economy. Bank of Japan given up on stimulating demand? Consumer demand I'm talking about now.
Well, again, I think you have to look at the Bank of Japan pre-Kuroda and then post-Kuroda. I think pre-Kuroda, yes, the Bank of Japan orthodoxy was really, was not to say, look, there is a shortage of demand in an aggregate demand management sense, that if we can only just sort of stoke up animal spirits a little bit and get demand up, the output gap closes, we'll then get inflation. It was this much more convoluted story that, yes, demand needed to be lifted, but it needed to be lifted as part of a long-term package of structural reforms that lifted potential growth and then lifted actual growth. The problem with that theory was that, if you believed it, you'd have to be very pessimistic about the chances of success, because the idea that you can, over any reasonable time frame, raise potential growth of an economy as big as Japan by a very tangible amount, enough to overturn a very long-term deflation, would require very aggressive, massive structural reform. I think post-Kuroda, in fact, Mr. Kuroda, as far as I can see from having looked at what he's been saying, he's been relatively parsimonious with his communication. He hasn't gone into a lot of detail about the exact transmission channel, but I do think he would think of some kind of transmission channel along the lines that Nathan has sketched out as well, where these changes in asset prices start to bring about increased confidence, and consumers do start to loosen the purse strings and start to consume more, and you get a virtuous cycle. But to me, this would be another reason for delaying the consumption tax hike, because the consumption tax is going to take purchasing power out of people's pockets.
And I'm keen. I mean, maybe this is too much economic engineering, but I'm keen to use the consumption tax as a mechanism to help generate inflation expectations in Japan. So I think they ought to announce several years of graduated consumption tax increases offset by decreases in other taxes, and particularly income taxes. And I think that could be, in tandem with a vigorous BOJ policy, could be a very powerful mechanism to help shape inflation expectations and help them to go and achieve what they would like to. The other thought I had on your original question is, over the last several decades, a lot of the fiscal stimulus packages have included a fair amount of tax cuts. And I think I would characterize those tax cuts as an effort to stimulate the demand side of the economy. It's debatable as to how successful they've been, but I think there's been some of that that they've experimented with as well.
Just a footnote, Kim, to that, given Nathan's interesting point there, is that when you look at the projections that the Bank of Japan is doing for future inflation, and we're going to get new projections at the end of April, and there's a lot of focus on whether they lift them, which they logically should. Interestingly enough, when the Bank of Japan reports those inflation forecasts, it reports two sets of numbers with the inflation, with the consumption hike, and then net of it. But the numbers that they've been focusing on in their communication is actually net of the consumption tax hike, which actually goes against Nathan's point. It will be interesting to see whether Governor Kuroda, who's been pulling a number of rabbits out of his hat, actually tackles this issue as well.
Yeah.
Let me interject one question. In Nathan's remarks, he argued that of the various transmission mechanisms for monetary policy, the most powerful one right now is the currency. We've had a big depreciation, at least back to levels that we witnessed several years ago. And you've seen some political complaints about that depreciation. Are we reaching the limits to what Japan can do using its currency? I'll just add one little aside for the audience. About 15 years ago, a well-known monetary economist who later became one of the central bank leaders in Sweden wrote a piece called "A Foolproof Way to End Japan's Deflation." And that essentially argued for fixing the Japanese exchange rate at a low value against the dollar and keeping it there in order to import U.S. inflation over the long run.
Yeah. This was actually my last slide that I skipped over. But I think that globally we're in a world that I would characterize as domestic mandate targeting. So if a central bank is pursuing its mandate for price stability, say, it more or less has carte blanche internationally, at least relative to G7 and G20 peers, to pursue aggressive policies to achieve that mandate. Now, I think the advocates of domestic mandate targeting, including folks at the Federal Reserve and the U.S. Treasury, would say that that is an acceptable program and isn't beggar thy neighbor. In fact, Bernanke's argue maybe it's enrich thy neighbor, because it's a well-specified, well-delineated objective that they're trying to achieve. And very importantly, once you have that mandate articulated, there's a well-defined stopping point. So the G20 is willing to endorse Japan's policies to end deflation and to achieve 2% inflation. But if Japan continued to pursue this policy at 3 and 4% inflation, there would be a real problem. So I think G7, G20, as long as you're consistent with this domestic mandate, I think you're on defensible territory. Now, that doesn't mean in fact, we've heard this over the last few days, that there won't be some complaints from other countries in Asia. And I think that's the place where there will be the most vigorous opposition, that a number of emerging Asian economies are now facing some very severe economic management problems, and part of it is related to the weakening exchange rate. Notably, these countries so far have not moved to similarly cut monetary policy and allow their currencies to depreciate, with Korea being the leading example of that. In fact, Korea has said our economy's soft, and they're going to do fiscal stimulus rather than monetary stimulus to try to offset that, which in the textbook suggests further currency appreciation. So it's a mixed bag. It's something that we're going to have to watch. For the global transmission of this shock, how emerging Asia responds will matter a lot. From a US perspective, Japan is less than 10% of our total trade. Once you add in all of Asia, you're up to a third of US trade or even more. If it's just 7 or 8% of US trade, that's a very absorbable shock for the United States. If emerging Asia goes with Japan into currency depreciation, it becomes much more complicated. And I think the same argument is true even more forcefully for Europe.
Yeah, no, I agree with Nathan on that point. I think the Bank of Japan is on very solid ground in taking aggressive action to achieve its price stability mandate.
Yes, sir. I think they're going to bring you a microphone.
Robert Laidley, independent financial consultant.
Sorry, yes, thank you.
Independent financial consultant. My question concerns overseas investment. My question concerns overseas investment by Japan, which I believe most people feel is desirable, but will it happen given the weaker currency? Would you please comment?
Let me just pick up a point that I just mentioned in my remarks, which is 311. I mean, I think one of the backdrops to why Japan has really reached very deep here is a real sense of alarm and urgency about the so-called hollowing out of the Japanese industrial base. The incentive of Japanese corporations, many of whom are represented in this room today, but I'm sure would testify, the incentive to move production facilities on a long-term strategic basis offshore after witnessing the devastation to the coastal infrastructure of the earthquake, of the tsunami, and then looking at the damage to the energy outlook in Japan and basically the virtual closing down of the nuclear power industry. On top of that, to have the nominal value of the yen going to 75, were just a number of compound shocks which all would point to Japan hollowing out more. So I would see the retracement in the yen here as helping to counteract some of the underlying imperatives which are really pointing in the other direction.
And I broadly agree with Paul on this, that the depreciation of the yen makes production in Japan relatively more attractive than was the case before. But I think many of the underlying drivers of that investment abroad are still very much in place. So maybe there's some retracement, but I think we'll come back to a trend of outflow, largely related to demographics and the availability of labor, that I think Japanese firms have huge incentives to find other sources of labor to use as production platforms.
Let me interject one more question. In discussing the tripod of policies, most of the talk has been about monetary policy and to some extent about fiscal policy. Paul made a couple of remarks about structural policy and argued that it's difficult to imagine that making a principal difference in terms of, for example, eventual fiscal sustainability. Is there much that we can expect? Should we expect much structural reform? How much can we expect? How quickly?
I certainly hope we see the structural reforms, and I think the structural reforms are largely motivated and necessitated by some of these demographic factors that I was just talking about. So I think that there is a severe need to take steps to try to raise labor force participation rates for women and particularly for elderly workers. Similarly, Japanese men between 25 and 54 work enormously long weeks. But for some of the other cohorts of workers to encourage more intensive participation in the labor force. I think that's one set of reforms that would be very powerful. Immigration, as an economist, it's hard not to mention that would have a transformative effect on the Japanese economy. But I think even with Prime Minister Abe, that the economics and politics still haven't quite aligned. And then finally, I think that there's scope for reforms to increase productivity and efficiency in the non-traded goods sectors, so wholesale, retail, and the like, to make these sectors more efficient. But structural, if Japan is going to have a renaissance and see growth rates on a sustained basis, let's say above 1.5%, even 2% for an extended period, it's going to require structural reforms. So it's necessary, but.
Kim, I think normally, and particularly for old Japan hands, such as many in this room, or Japanese themselves, would be very cynical about, or very discount heavily kind of policy rhetoric about pursuing structural reforms. Japan has a little cottage industry revolving around the cabinet office, churning out reports on structural reform. Every prime minister that comes in talks about structural reforms, etc. And it's a very shopping list kind of, throw everything in the kitchen sink approach. But hopefully Mr. Abe will be different. He's proved himself to be different on monetary policy. He's also sending, by Japanese standards, very contrarian signals on fiscal policy. So I think structural reform policy is really the open question here. What I do find interesting is you want to do structural reform regardless, but you don't have to do it to end deflation. They're sort of additives rather than two things that are dependent on one another. But what would you look for? Well, I think we've seen interesting stuff on TPP. Mr. Abe surprised people by moving ahead of the election on that. And again, I would echo Nathan here. If you really want to lift Japan's potential growth rate and revitalize the economy, you do things about immigration. You put in place an immigration policy that is smart for the Japanese. There are ways of doing that. And also perhaps have some positive spin-offs in terms of relationships with Asia. And you work very hard to raise the fertility rate domestically. And I think the way you do that is having a laser focus on trying to organize a society where women, 50% of Japan's great human resources, can stay in the workforce and yet have children, have families. That's a little bit difficult to do in Japan. So I think I'm not looking for a shopping list from Mr. Abe. I'm looking for some sort of clarity and big picture items that take people by surprise. And after the election, I guess, is the time to wait for that, because it does look like the LDP will have a big majority in both houses of parliament, and really for the first time in 20, 25 years in Japan, have the political wherewithal for a strong leader to really push through a structural reform agenda. I don't think you need lots of councils going over report after report, recommendation after recommendation. I think there are 2 or 3 things you could really just run with here.
No one mentioned agriculture.
TPP relates to agriculture.
There you go.
Although there's a discussion of a carve-out for agriculture in TPP. Yes, Richard. Just identify yourself.
Yeah. I'm Richard Katz. I'm from the Oriental Economist Report. I have a question about the yen. If that is, indeed, I know Paul agrees it's the main transmission mechanism, but assuming that you do, I have a question about it. Of course, it has costs and benefits. The cost is you're paying a lot more for imports. For example, oil prices, energy prices are way, way up. And that's the bad kind of inflation, which hurts growth, just like OPEC doubling oil prices would hurt growth. The benefit, which you'd hope would be greater than the cost, would be an improvement in exports. But if we look at the behavior of exporters so far, they have 2 choices. They can take advantage of the weaker yen to lower their prices in their destination markets and therefore grab more market share, which increases the real volume of exports, therefore more hiring, more investment, multipliers, et cetera. Or they can leave the dollar price for a Camry the same and get more yen, which is very nice for Toyota's profits, very nice for the shareholders in Toyota, but as a result, real exports don't do nothing. And that's what we've seen so far in the 6 months since the September. That is, they've raised prices about 18%, the same as the yen dollar has gone up. And real exports actually are still falling. They're 30% below what they were before the recession. So my question is, going forward, what mix do you see in terms of the exporters not just using the weak yen to raise prices, but actually to grab market share? And then when you take that into account, what really can we expect that is X percentage of change in these prices will yield what kind of change in growth? Because I think your equation, talking about 2% GDP, you may have presumed they're going to use this to lower prices, but if they don't, then what kind of bang do you get for that buck?
Yeah. So a very good question. And I think that the response you described of what they're actually doing is exactly what you'd expect them to do under the circumstance that they're not quite sure where the yen is going to be over the medium to long run. Now, if over time it becomes clear that this exchange rate move is a permanent one, well, maybe at that point they'll have sufficient confidence to reduce their dollar prices and increase their production and try to increase the market share. So I think that is something that would expect to have happen over quarters and maybe even over years, where you see these kinds of more dramatic shifts in actual production. In terms of my relationship that I showed up there, what I found, and let me put this as directly as I can, a 10% depreciation of the broad yen is associated with about 3/4 percentage point increase in real net exports. So in some sense, we're holding the prices constant in that 3/4. It's also associated with about a 4/10 percentage point increase or a GDP increase in the current account surplus. And that difference between the 3/4 percentage point real and 4/10 nominal with the current account is this adverse trade effect, the higher import prices relative to export prices. So there's still a positive effect any way you cut it, even after allowing import prices to rise, but it's a smaller one than when prices are constant.
I'll leave it.
Gentlemen, questions?
Hugh.
Yes, you.
Hugh Patrick, Columbia Business School. Assuming that the monetary policy is successful and you get a CPI rise of 2%, is this going to lead, how do you prevent a JGB, a Japanese government bond market crisis? Because this will put tremendous pressure on prices.
I'm not sure that that is going to be the outcome here. I mean, what I've always argued and had that question, like Nathan, many times from clients, is to really say, look, you have to look at this in a more, sorry for the jargon, but more of a general equilibrium rather than a partial equilibrium kind of context here. Yes, of course, if Japan does get out of deflation, the nominal interest rates have to go up. That means that the nominal debt servicing costs for the government will go up. But there will be other effects as well. The whole equilibrium or the whole behavior of the economy will be changing as part of a set of changes that, as one element, has higher bond yields associated with it. So in other words, the equity market will probably be up considerably from here. Nominal GDP growth will be actually growth, not contraction. The level of nominal GDP in Japan is 10% below the 1997 peak. So let's say that nominal GDP is growing at 3%, which is kind of the target. That means that tax revenue, pretty much for the first time in 20 years, is also picking up. And definitely bond prices and bond yields will have to adjust, but I'm not necessarily sure why that has to lead to a JGB crisis per se. It leads to a portfolio readjustment approach. Let me throw one more just angle in here, which we haven't really focused on today, is that something else has happened with Mr. Kuroda taking over from Mr. Shirakawa, which is that the governorship of the Bank of Japan has gone from a Bank of Japan official to an ex-Ministry of Finance official, a very senior official. And so I think that in terms of debt management and coordination between the Bank of Japan and the Ministry of Finance, I think the template now with, now of course Mr. Kuroda is acting as the Bank of Japan governor, but of course he has very close links to the Ministry of Finance, and I think you'd find the cooperation at various levels to be improved here. So there's a sort of an interaction between monetary policy and also debt management policy. That's what quantitative easing is at some level, is a kind of giant debt management exercise of the consolidated government, where you essentially are able to lower your debt servicing costs. So I think that the authorities actually have a number of cards here. And I don't think that an exit from deflation would necessarily be a trigger for a fiscal crisis. I'd be more worried if you never did anything about this problem and you let the frog boil and eventually wake up one day where debt to GDP is 500% of GDP. Right. And then you do have probably an unsustainable situation.
And the corollary to that is it's going to be harder under the current trajectory than if this had been done 10 or 15 years ago. I think your question generalizes to how do central banks end QE programs, and how do they do it in a way that's not disruptive to financial markets? And if there's any hope for Japan, it may be, if things go well in the United States, that the Fed will be leading the way in this one. And the BOJ can learn from the Fed's experience rather than the other way around. I'd say one risk I'm worried about is they start being successful and JGB yields rise, and that forces the BOJ to stay in and continue purchasing longer than the BOJ would otherwise. I think those kinds of risks are very pronounced, and I think it's going to be very much an ad hoc kind of process to figure out how to get out.
Just to elaborate on that, any comments on how this evolution is going to affect the stability of the financial system, and particularly the balance sheets of the banks?
I'm worried about it. Now that said, in the late 90s, I was the Fed's Japan analyst. And I remember speaking with my colleague who was following Japan for the New York Fed, and we were wondering, well, when rates rise, how's that going to influence the Japanese banking system? And in the event it didn't. Rates didn't rise, that is. And I think there might be an important point here. If we are going to have instability in the JGB market and a sharp increase in rates, who is going to sell? And to the extent that it's state-owned institutions and other institutions that are watched closely by the Japanese government, maybe there is a macroprudential tool that can be operated to manage the exit independent of monetary policy, and that macroprudential intervention would be optimal for the government, for the Bank of Japan, and for those institutions themselves, help solve a coordination problem.
No, I mean, definitely it's going to be a challenging issue here. And people worry about these issues in the context of the Fed and quantitative easing in the developed world. Of course, Japan's been at this zero interest rate deflation stuff for a long, long time. So Japanese institutions, a lot of JGBs out there. Those JGBs in aggregate have to be held on balance sheets. And there's just no way getting around the fact that yields are going to go up. They have to go up. But I do think, as Nathan suggests, that really is a reason. It's not a reason not to do aggressive monetary policy. It's a reason for the macroprudential authorities to be, really all over this issue. One thing that is a slight disadvantage here for Japan is that in the good old days when we were studying the Japanese main bank system, Kim, remember Japanese banks had a lot of equities on their balance sheets. And that was actually a bit of a hedge on the balance sheet. Yeah. And one of the sort of byproducts of the financial crisis in Japan and the regulatory response was to say we've got to clamp down on that. And it's a little bit of a, there was a bit of a kind of an opportunity cost there, because now as the equities rally in Japan, and hopefully rally further, the banks are not able to capture that on their balance sheet in the same way that they used to be able to do so.
Although the collateral for their loans presumably is improving. Right?
That's going to improve.
On that note, I hope you'll join me in thanking our distinguished panelists and the Japan Society.